Have you heard that through a covered call strategy, you can increase the income that you earn from dividend stocks or other stocks 3, 4, 5, 6 times over? Well, it's true that you can. In this video, I'm going to show you how a covered call strategy works. Let's start with an example. Let's say that you buy 400 shares of stock at $50. And let's further say that the dividend income on that stock is about 2%. That ends up bringing in about $400 a year in dividend income. And while that stock may increase in value, it may not. So you're going to make about $400 dividend income from the stock. On the other hand, with a covered call strategy, you could sell 4 call option contracts about 5 weeks out for $1 each and bring in about $400 about every 5 weeks. Now, optimistically, and assuming that the market is either sideways or increasing, and this stock is therefore increasing in value, let's say that you could do that about 9 times a year. That's realistic in a sideways or an uptrending stock. So in this case, if you were able to do that every 5 weeks or so, and say the timing is not perfect, but you're able to do that 9 times a year, that's $3,600 of income using a covered call strategy. And not only that, you would have the dividend income of about 2% as well. So we're talking some pretty good income from stocks. Hi, I'm Camille Gaines here, and on my website, retirecertain.com, I write about my investing adventure over the past 40 years or so and about creating alternative income streams over the past 15 years or so, along with my husband after we stumbled into early retirement. One of the best ways to generate income is from a covered call strategy, but there's some really important things to know about covered call strategies. In this video, I'll tell you exactly how they work. I'll step through that $3,600 that was generated by owning those 400 shares of stock that we looked at. And then I'll tell you what I learned after I sold covered calls. Now, when I first sold covered calls, I was totally and immediately hooked. I like to study investment strategies really extensively and then try them out. So I decided that I was going to sell covered calls. It just seemed too good to be true, which is always a sign, right? With anything. So I sold covered calls on high growth stocks that I found in IBD that I wanted to own anyway. And this was back in 2006. The first month I sold covered calls, I made 7% on the amount that I invested in these high growth stocks. So I was obviously hooked. What I've learned since then, and I've sold hundreds, if maybe probably over 1,000 for sure, covered calls since then. What I've learned is super important though from an overall wealth management perspective, because I think, and everything I write about and talk about at Retire Certain is about keeping the money that you make, because that's as important as making money. I'm going to step you through that strategy, making the $3,600, show you exactly how to sell a covered call, and then I'll tell you the most important thing from a risk perspective. So make sure you stay tuned to the end. I've created a little acronym for this, and the word we're going to use is SOAR, S-O-A-R, and that will help you remember the important elements of selling covered calls. The very first important thing that you'll want to know is the strike price. Okay, that's the price that you are obligated to sell your stock should the option get exercised. All right, Kate, okay, in this example, we used $50 as our strike price. Now, you might remember that the cost of our stock was $50. So we're going to circle back to that in just a second. But for now, let's remember the strike price is $50, and the strike price is super important in a covered call strategy. So in our example, we are selling 4 call options with a $50 strike price. Okay? The next really important thing, we've got the S with strike, so the O is the option expiration. That means that by the option expiration date that we choose, we will be obligated to sell that stock up until that option expiration, I should say. So, for example, the person that we sell that call option to has the right to exercise it or to buy that stock from us at $50 a share anytime up until that option expiration date. Most of the time, if a stock's going to get purchased via a covered call transaction, that happens at option expiration. But sometimes I've sold call options and the buyer has exercised their right to buy that stock from me well in advance of option expiration. Sometimes this is so that they can capture a dividend, or sometimes it's just because it comes out favorably. Whatever happens, I get to keep that income from selling the covered call, but I'm getting ahead of myself. Okay, so we've got the strike price of $50. We've got the option expiration. Now, in the example I gave, we said we're going to sell a call option 5 weeks out. So let's say that that's a monthly option, and I won't get into a whole lot of detail. I'll just say that there are monthly options and there are weekly options for a lot of stocks as well. And there are also leaps, which are very long-term options. We won't get into that. We'll just remember in this example, we're using monthly options. Those are the most common kind of options that are used for cover calls. So we've got the strike, we've got the option expiration 5 weeks out. Okay, the next thing we're going to look at is the A, and that stands for at the money, but we also have in the money or out of the money. Let me explain that. Okay, in this example, we sold a call option with a $50 strike. Since $50 was the value of the stock, the market value of the stock, and it also happens to be our cost. In this example, we're going to say that we did this simultaneously. We bought that stock and we're selling the call option at the same time. That's not always the cost, because you can sell call options against stocks you've owned for years, and that can be a great strategy for bringing in income. But in this example, we're going to say we bought that stock for $50 and we immediately sold a call option that had a $50 strike. That means it was right at the money. That strike price was right exactly what we paid for that stock. And that happens sometimes. You know, you may be a few pennies over or under, or you may be a dime or a nickel over and under, but it's not at all unusual to sell a call option with a strike price that's right at our cost and or the market value. So what we're really looking at when we're looking at this at any given time, as far as the at the money, in the money, or out of the money, we're looking at the market value, not our cost if we bought it a long time ago. But remember, in this example, we're doing both at the same time. So we've got the stock, we sold it with the strike price of $50. The option expiration is about 5 weeks out, and it's at the money because it's a $50 strike price. And at the time of this transaction, the stock is trading at $50. All right, now I told you I would explain the in the money and the out of the money, okay? In the money, what if we sold a call option that had a $45 strike price? In that case, we would be in the money. That's because the stock price is $50 and the strike is $45. It's in the money, okay? The stock price is above the call option, the strike price, okay? Now what about out of the money? Okay, out of the money would be if we sold a $55 strike, an option with a $55 strike, then that would be out of the money. And that's because, well, $55 is above the market price of $55 is above the market price of $50. Let me make sure I'm saying that just right. So that's at the money, in the money, and out of the money. Okay, so we've looked at the strike price, we've looked at the option expiration, and we've looked at the fact that this is at the money. But sometimes options are sold in the money or out of the money. And then the very next thing that's really important with options, or covered call strategies, I should say, is that R in SOAR, because remember that with covered call, the income soars over what you can get from dividends. So the R is relative to your cost. So I mentioned that sometimes you sell call options on stocks that you've owned for a long time. This is a great way to generate extra income. And in this example, we sold it. We're doing this simultaneously. We sold the call option right when we bought the stock, or right after we bought the stock. But what's really important with the R, we want to know where the strike price is relative to our cost. Because in that example I gave, where if you sold an in-the-money call option and that strike was $45, and the person you sold that call option to decided to exercise that call option, you would have to sell that stock to them for $45. What would happen with the stock situation? You would lose $5. Whereas if you sold it if it got exercised, I should say, and you had sold an at-the-money call option with a strike price of $50 right there at the money, you would just break even on the stock. Okay? Here's what's great though. No matter what happens to the price of the stock, you get to keep the money you made from selling that call option, regardless of whether the stock goes up or down. Now, there's so much more we could say about this, and in the money and out of the money and at the money, and the best strategy for whether you're trying to get income or capital gains or lowest risk, or whether this is in a retirement account, or whether you're trying to live off your investments. I'm not going to overwhelm you. I just want to explain this example I gave and really point out, as I always like to do, about the risk that's involved with this. And so I'm doing that next. All right, but let me say a couple more things about the math behind that $3,600. How did I come up with that? So in this example, we sold a call option for $1. And since we had 400 shares of stock, we could sell 4 call options. So we say 4 times $1 for the price that we gave for selling that option contract. Okay, now I get it. The math is $4, right? It doesn't quite add up. And this is, I don't know, to be honest, it's always a tiny bit confusing to me. But here's what's great. It's really simple. One option contract represents 100 shares of stock. So you get to take that $4 and say times 100. So you make $400, not $4, when you sell the call options against your 400 shares of stock. That's how I came up with the $3,600 if you sold the call options and made $400 every time you did. Now that I've explained the option expiration and explained how we're selling those call options that are 5 weeks out, you can see how in 52 weeks, which is a whole year, we may be able to do this 9 times realistically, because, well, that's 9 times 5 is 45 weeks, and that leaves us with 7 weeks that we're still kind of either playing around or not selling a call option, or it didn't work out quite the way we thought it would, allowing us to sell it every 5 weeks. So I like to be conservative in my estimates. I don't want to say we could do this 12 times a year. You know, sometimes I'll end up selling a call option and I'll buy it back in a week or two, depending on what the stock does. But here's something really important. And I told you I was going to tell you 2 really important risk factors about covered calls, and I'm going to do that now. But basic covered calls, they work only in sideways or bull markets, okay? So why is that the case? Well, let's say in the example we saw, if your cost of the stock was $50, and let's say you rolled along and it was going great, and you sold covered calls 5 weeks out, making about $400 every time, and you did that for a year, or a couple of years, 3 or 4 years, and then boom, we enter a bear market and your stock drops 50% just because the overall market dropped 50% and it went right down there with it, then your cost is $50 still. But say the market value has dropped to $45. If you sold a call option with a strike that was at the money or near the money, then you would be losing money on your stock position if it got exercised. So they stop working. And then you're just left with your portfolio of stocks, which hopefully and most likely, if you've chosen well, will come back over time. That's what most stock investors do. They invest in stocks knowing they're going to go down, and they ride out the bear markets. I use a little different tactical strategy, but most people, that's how they invest, and that's really sort of how it works. They come back eventually after bear markets. Most stocks do. So those are two really important risk factors to consider in a covered call strategy if it's something that you choose to implement. If you like covered call strategies and alternative income streams and investments, make sure you subscribe. This is what my channel is all about.